For our August 2021 Mortgage Monthly show, we had CU Members Mortgage's very own Keith Kasmire on, talking about the current mortgage trends and battling the appraisal challenge. Tons of takeaways in this talk with Keith, so check it out. Hey, welcome everybody to this month's Mortgage Monthly, brought to you by the fine folks at CU Members Mortgage. And our guest today is none other than Mr. Keith Kasmire, also from CU Members Mortgage. Keith, how are you today, sir?
I'm doing great, Mike. Good to see you. Thanks for inviting us to join you today.
Oh my gosh, anytime. I love this series because not only is our audience getting educated, I'm getting educated as well. So I'm almost on. No, I was about to say I'm almost on par with you, Keith, but I'm nowhere near that. Well, but we're getting there. Baby steps.
Okay. Not even sure that's a goal you want to pursue, Mike, but we'll go for it there.
Well, I mean, I think this is a really good area. All the areas in finance are pretty good to be educated in, but this one especially if you're in to buy a home or selling a home or doing whatever these days. So I just want to dive into the topic here. So today's topic is current mortgage trends. And oh my, that's like herding cats today. And then battling the appraisal challenge. So Keith, before we get into that, I understand that we have some survey results to share with us today. Is that right?
Well, Mike, that's right. And I think that helps us to get a little bit of perspective. Just the other day, the CFPB, along with the FHFA, released their annual results of their national survey of mortgage originations. Now, this is a survey they do every year, and you can put that into your favorite search engine, NSMO, and you can find these survey results, which they publish. I took a look, and I was very interested to be able to go back and look at the last decade, from 2010 to what we would call the teens, I guess, and see what has changed over the past 10 years.
And a lot has changed over the last 10 years. Oh my gosh. So in 2010, we were just coming out of the financial meltdown, as we all recall, but we try not to recall. But there were many lessons learned back then. So it's good to actually look back on that and not do those again. So the CFPB didn't even exist as then as well. So my gosh, things have changed quite a bit in the last 10 years, right?
That's right. Yeah. In 2010, we couldn't even spell TRID. So a lot has changed. And some things haven't changed. So the first thing that I looked at was percentage of borrowers that are putting 3% down. And I would have thought that had gone up considerably. And I was really surprised to see hasn't changed a bit. It was about 11.5% 10 years ago, about 11.5% now. Now, what has changed, average loan size has gone up considerably. Average loan size has gone up 30% over the past decade. Average collateral value has only gone up 20%.
Okay. So
that tells us something, right? Folks are financing a higher percentage of the home purchase.
Right.
And that's not surprising when we see that loans from 80 to 95% LTV, those have gone up considerably. It's gone from a quarter of all loans to now almost a third.
Good grief.
So, we are seeing that. Credit scores have been pretty stable. Average credit score has come down a tiny bit. Some of that might be due to reporting methodology. But the number of borrowers who have either very good or exceptional credit remains extremely high at nearly 85% of all mortgage borrowers.
Really? Okay. Sounds good. Anything else on that one?
And, home owner-occupied borrowers, 95% of loans were owner-occupied 10 years ago. 95% of homes are owner-occupied today. So that hasn't changed a bit. Okay.
So it sounds like that mortgages are overwhelmingly to owner-occupied borrowers with good credit, but the loan to value is creeping up a little bit. So is that the picture right now that we're experiencing?
Well, that's part of it, sure. And I think there's more.
Okay.
I'm old enough to remember when we were shooting for a debt ratio target of 28-36, and 36 back ratio was considered the upper end of approvability. Well, now it's the average. And the number of borrowers with a back-end ratio of 36% or above has gone up 12% over the past 10 years and is now more than half of all borrowers.
Good grief.
So housing continues to take a bigger chunk out of the family budget.
Mm-hmm.
Now, speaking of families, there's some good news there. First-time home buyers have nearly doubled in the past 10 years. It was 16% in 2010, up to 29% as the last survey.
Okay.
And the last thing I looked at was product mix. 10 years ago, about 1 out of 4 loans we did was government insured loan, FHA, VA, USDA. Today, about 25% of the loans we do are government, FHA, VA.
Okay.
So that really hasn't changed much. What has changed a little bit is the percentage of volume that's going to the GSEs, Fannie Freddie.
Mm-hmm.
That has actually come down about 10%, but still represents more than half of all of the mortgage market out there.
Okay.
If that's come down, what's come up?
Yeah.
Well, portfolio loans have come up considerably.
Okay.
Institutions are putting more mortgage loans on their books, probably a reflection of the fact that we still have strong borrower. We're making better loans today than we ever did, and I think that's allowed credit unions to get past some of their long-term rate risk. Lastly, jumbo loans have gone up pretty considerably over 10 years, but still only about 4 or 5% of the total market.
Okay. So obviously it sounds like, like some things are different, obviously. So can we draw any conclusions from this information you just provided us?
The numbers tell us what we probably already knew intuitively.
Mm-hmm.
Housing costs more these days. That's putting pressure on both down payments and family budgets. First-time buyers are up, which is good, but those families, and all families really, are spending more on housing than they did in the past. Nevertheless, they continue to be good credit risks, and financial institutions, credit unions are recognizing that and putting more of those loans on their books.
Indeed. So the old saying, history repeats itself. So any chance that the recent sudden escalation of home values and the red hot real estate market will result in another meltdown, because things are off the hook, as they used to say right now?
Yeah, well, first of all, I'm not a fortune teller. I took my crystal ball to the TV repair shop to get it fixed, and they went out of business. I haven't seen it since. So,
that might be a good thing, Keith.
But yeah, the markets are crazy. They're crazy where you're at. They're crazy where I'm at. But when you look at the factors that drove up the rapid escalation of values in the early part of this century, the bubble, if you will, it had a lot to do with easy money and not a lot of accountability.
Exactly. That's what I was thinking too.
And I think that there are guardrails that we've put in place since then that now there are different forces driving the market up today. And I'm not saying certain markets aren't overvalued, but I don't think we're steering the boat towards the iceberg like we did in 2006.
Okay. Good to hear.
And, I'll add that, we did learn some lessons from that time. And I think you see that in, the lack of foreclosures, the forbearance work that we've done with borrowers during COVID has kept people in their homes. And that has kept the market stable in ways that we didn't do successfully 12 or 15 years ago.
Yeah, exactly. Yeah. And I've been seeing more and more stories about that forbearance coming to an end here, but that's a whole nother show that we'll address at another time. But yeah, you're spot on there for sure. Hey, speaking of home values, let's segue from our history lesson, if you will, of the past decade to what's happening right now, because we want to know what's going on right now. So we're hearing a lot of chatter about appraisal issues, and yeah, a lot of it. So how much of a challenge is this right now in today's current market?
Mike, we're hearing about it too, and we're seeing it firsthand in some cases. It's not a problem in every market, but it is widespread. We're hearing stories about exorbitant fees, about lengthy delays, and we're hearing about appraisers that are just flat out refusing assignments.
Really? Oh my gosh. So that sounds like it would result in a lot of disruption. What's causing it? What's going on?
Well, it's not like a lot of things. It's not one cause. There's a lot of factors at play here, but one of them is the fact that the appraisers are not getting any younger. And market conditions over the past decade or so have not been very conducive to new people entering the profession. So, appraisers are getting older. It takes a long time to work your way up in that business, and the economics of that journey aren't necessarily very attractive, particularly given the boom and bust cycles of the housing market. So that's a factor. The AMCs have put additional financial pressure, made it less profitable, if you will, for appraisers.
Really? Oh, gosh.
And there's concerns about automation replacing that as a function. So, a lot of different factors going into it.
Yeah, no doubt. So if I'm a credit union that's having trouble getting prompt and reasonably priced appraisals, what should I do? Where do I go? Sounds like
there are some things you can do.
Oh, good. Okay.
Firstly, if you work with an appraisal management company, I think you open a dialogue with them. You emphasize the importance of consistency. Be a good business partner and expect the same from your counterparty. If your loan policy does not require that you use an AMC and you have an appraisal panel, you can carefully cultivate goodwill with the appraisers on your panel. We have heard of anecdotes of appraisers who are giving preferential treatment to local lenders. But be careful here. A lot of the courtesies of commerce that are extended in other areas of business are prohibited by some of the rules that we have in our world. So, but the relationship that you have with the appraiser can be a factor.
Yeah.
And you can also consider alternatives to an appraisal in some cases. Make your loan without the benefit of a traditional appraisal.
Wait a minute, Keith. Lending without an appraisal? Are you kidding me? What's going on? So wasn't an honest appraisal one of the guardrails that you mentioned earlier? Because this sounds like it's an important part of the process.
Well, yes. And, those guardrails have stopped the hit the number inflated appraisals that we saw in some cases years ago. But I'm talking about a different level of risk management here. Let's say, for example, you've got a borrower who paid $250,000 for their home 6 years ago.
Right.
They now say it's worth $300,000. That's about what other houses in the neighborhood are going for. The tax assessment's $270,000. Do I really need an appraisal to refinance that member's mortgage balance?
Makes sense. So you're saying that they should just guess at the value from here, or?
No, I'm saying there are alternatives to the traditional appraisal, especially when you've got a strong borrower and you're not pushing the limits on LTV.
Okay, gotcha.
You're doing secondary market lending and you get an appraisal waiver from the investor, use it. If you're lending for your portfolio, know your market. In some cases, you can use a tax assessment that's a reliable indicator of value. In other markets, it's not. There are automated valuation tools. Heck, there's Zillow. And I'm not saying you should make loans based upon Zillow, but I'm saying you should write some common sense into your lending policy and consider another written valuation tool other than the traditional appraisal. I mean, I really think that's going to be the future in some respects for valuation. Not that appraisers are going to go away, but the norm in the future may be an automated valuation tool rather than the traditional home inspection that we've used in the past. And,
right.
The question really becomes, will automation push the appraisers out of business, or will the appraisers force us to go to automation?
The chicken before the egg question, I think it sounds like, Keith.
I believe that is the chicken and the egg question.
So that would certainly be a welcome change for credit union members who are feeling the pressure of appraisal delays, because I know out here in Southern California, we're experiencing that big time.
Lots going on in the business, Michael. Lots of changes. Current spike in home values is just widening the gap between affordability and members of modest means. I think we will see some efforts in policy making to try to bridge that gap and create more homeownership opportunity. The digitization of our industry continues.
Oh, yeah.
And credit unions really need to be paying attention to the value of the data that they are. If you are selling on the secondary market, know what you are selling when that loan leaves your institution. And the cost and complexity of originating a loan continues to snowball, and that is ripe for disruption. And I think we're going to see some changes in that. It's just gotten too darn expensive to make a mortgage loan these days. But these are all potential future topics for our next episode of Mortgage Monthly.
Yeah, which will happen in 30 days from now. Oh my gosh, Keith, this is fantastic stuff here, obviously. And we're just scratching the surface, like you said. So anything else? Any final thoughts on this topic? Because, I mean, obviously we could go into like a million avenues on this, but overall, what we talked about today, any final thoughts to kind of wrap up here?
Final thoughts, I will unsuccessfully avoid a cliche here, but in looking back over the past 10 years and the changes that have occurred, I'm reminded of that old saying, those who don't study history are doomed to repeat it. So,
yes, sir. Very true indeed. All right. Well said, Keith. So thank you again for this information today. Again, we're just scratching the surface. So if you guys have any questions, feel free to call up the folks at CU Members Mortgage. Keith will actually be very happy to talk with you as well about any questions you have, because we all have questions, because what's going on right now, Keith, is so dynamic. Things are moving like they've never moved before. So it's just really
not going to slow down.
Yeah, exactly. It's not going to slow down at all. So, all right. So again, for more information, go to cumembers.com or go and there's all the contact information there. We'll put that in the show notes for the recording as well, so you guys can get right to them and provide them with your questions, and they'll have the answers. I know they do. And thank you again, everybody, for watching today's Mortgage Monthly, and thank you, Keith, for taking time out of your busy schedule to chat with us and share your expertise. So we always appreciate that. So well done, sir.
Thank you very much. Can you believe it's almost fall of 21?
No, this year has gone by so fast. So, all right. Well, again, thanks again. Appreciate it, Keith. Great topic, great discussion. And then again, we'll see you guys in another month, in 30 days. So stay tuned. We'll see you in 30 days.